Oh, I feel pretty solid about this. Okay, so view the slideshow. I'm going to minimize you. So if you have questions or comments or anything along the way, feel free to just launch in and but I won't be able to see if you raise your hand in camera.
Okay, no worries.
Okay, and so this talk, to give context, was given on August 10th, so just a few weeks ago. And we had everyone into the Douglas Truth Library. We had assembled a collection of about 30, 35 or so investors and startup founders to engage them in this proposition of how might we build a Black Angel network and whether we should or not. So August is Black Business Month, and so we have a photo of John William Templeton, the guy that started Black Business Month, which is an interesting historical note. He's still around. So with the agenda, we just went through and introduced ourselves, and then did some welcomings and talk from sponsors. We did an interactive questionnaire with a really cool tool called Mentimeter, which does live crowd feedback on a bar graph. And so we'll just kind of tab through those questions. And then we talked about what is angel investing, how is it different than like a venture capital fund, and so forth. Some examples are Sequoia Capital, Madrona Ventures, Green Book Ventures. We talked about what the current color lines of investment are that make it very problematic. We talked about what those systemic problems look like and why they kind of demand action. And then we launched into, how is a Black Angel Network a solution and how can we do it? And then kind of did a call to action to invite people to join. And there's a mechanism, the Seattle Angel Conference, which I went through back in March, which is a event fund where in my iteration, 40 investors of varying backgrounds and skill sets. Some people, were early investors in other startups that had successful exits. Some were investment bankers. Some were people that had worked in university tech transfer departments. Some people were biotech folks that got out and went to vet investments for VC, just a broad collection of people. And then we evaluated 80 startups down to one finalist. And so that took place every Tuesday evening and a few Wednesdays over the course of about 3 months. And so that goes on twice a year. The next round of it starts August 29th. And so part of this was trying to get people into that Seattle Angel Conference in order to get them trained up so that we could have a shared vocabulary to launch into the creation of this network. And then we said, who will join us, to basically get people to see if they'd sign up as either a founder or as an investor. And then, questions. And then we did a nice social event across the street at the William Grove Center on 23rd and Yesler.
Okay.
So talking about the overall picture of ecosystem development. So Africatown and a lot of other community organizations are working in the space of early exposure and socialization, education and skills development, talent placement, getting people into career connected learning, which gets them into internships and things like this, innovation, so doing startup incubators, accelerators and things like that. Or I should really say actually just design ciphers like hackathons and things like that. And then entrepreneurship, having them go out and do business acceleration, things like that. We've worked with Mortar, which is a franchise business accelerator, I think out of Ohio, and had I think a couple iterations of that through Black Dot. But Urban Impact exists in the space, and they're have won awards for their incubator and things like that. So we've been kicking it around. Yes.
Oh, no, I was just say, you said it was a franchise accelerator out of Chicago
I think Cincinnati,
or
Ohio.
Cincinnati. That's interesting. I'd love to learn more about that later on because multiple companies have approached Ibrahim. I think Franchise Creators is one about franchising Fishbox, but if there's a more tapped in resource with the community that that you guys have vetted, or I think it'd be good for him to learn more about that.
Oh, I actually know a guy. I was at the Black Leadership Business thing that Lewis Rudd had put on, the founder of Izel's Famous Chicken.
Mm-hmm.
Um, he franchised through a company, and so he invited them out to his conference. So it at least has his vote of confidence. This is a law firm that specializes in franchise law and franchising organizations. I sat
Okay.
in on the conference talk that they did on that subject, and
Yeah.
um, and I can forward that information across because it's
Okay.
definitely a valuable tool for scaling out and comes with some considerations. But the
Okay.
guy had a great slide deck for it, and we went through that. So I'll forward. I'll see if I can find his slides, or I'll just have him send his slides and to you with his contact.
Okay.
But yeah, the accelerator was actually, it was a franchise itself, so it was like a curriculum for a startup accelerator that
Okay. Got it.
had a little bit of hand holding, and so we were new to trying to build a business or startup accelerator, and we liked their content because it related a lot of the key business concepts back to like the recording industry, which has like a lot of like knowledge penetration in the Black community.
Mm-hmm.
So like couching all the terms of how one might organize a business or reach a market, in that kind of, market paradigm, that seemed like a good way to propagate the information. But the thing that we are missing in a lot of our ecosystem development is this market and capital access. And without that, it's really hard to have this top bit, which is the wealth and job creation. So, in the front part of this talk, I'll go over a lot of the stats about this, and postulate why we're having some issues on this end, and just there are some people like Dinsham Co-op with what is it, Dion, who runs revenue-based financing, character-based lending kind of stuff to try to get some market capital access
Mm-hmm.
in the CD community. But there's a big gap for this. And so you, of course, have, familiar with this. And then, everywhere we go, whenever we talk, people are like, yeah, where's the market capital access? So we know that it's a gap in knowledge or availability. So then this next slide was to essentially highlight the central district. You probably don't need any more information on this, but we do have just kind of some interesting notes. So we have, the Garfield Super Campus and its Performing Arts Center, and just the various great things going on there.
Mm-hmm.
Langston Hughes Center for Performing Arts. So there's kind of like this interplay of arts, technology, and business, which we think, can lead to really successful collaborations. So we built the William Gross Center for Cultural Innovation here on 23rd and Yesler. And so here we teach people about creative industry, STEM, and entrepreneurship. So we try to wrap around those different things. Right now, we're actually building like a film studio there to try to further engage like the arts people, but
Mm-hmm.
making it kind of a special effects driven thing so that we can get people doing like digital asset creation, for the gaming world and for the special effects world, and then also get them physically making things with the makerspace. Props for
Mm-hmm.
that. And then just down the road, there's the Wood Technology Center where they, on a quarterly basis, create two tiny homes, and then also they do once a year a wooden boat sale where they've made a bunch of different wooden boats in their wooden boat shop. So they teach a lot of practical applied technology relating to construction. They have a construction program that gets you from barely being able to swing a hammer to employable by the construction trades within 11, I think it's 11 weeks. So a really useful resource to get people into jobs, physical jobs in the community. And then of course on Jackson, we have, so many flourishing Black businesses, things like that. So this was an open invitation to get people thinking about investing in community in this kind of Black Wall Street paradigm that's being created, especially with Black Coffee Northwest taking over what was once the Starbucks there on the corner of 23rd and Jackson's.
This makes me this makes me think. So that building, First Place School that we're in,
Mhm.
so we're on the third floor, right? We just use a commercial kitchen. The school, so there were two schools in there. First Place School is on the first floor, and then on the second and third floor was Seattle Christian School, and they just moved out. And so I know that the owners of the building were trying to figure out like, what are we going to do with the rest of the space now that this other school has moved out. But as you were talking, it just made me think
Hmm.
it might be a good idea to turn that into some sort of creator space
Ooh.
because they have like, they have different rooms that they use for classrooms and like, different offices and stuff. So people could like if they wanted to set up, if we had a way to set up like different couches or whatever in different rooms, different settings, where people could like host their podcasts, or they could create content, or they could, you know what I mean? And
Yeah,
then,
we could definitely make something like that happen.
yeah, because I'm just looking at this whole, how you laid out the area, and like, I'm just looking at like, you have the William Gross Center for Cultural Innovation, like hosting like all of um the digital coding and stuff that you talked about in the Wood Center. And I'm like, who has a creative space? And
Hmm.
actually one of my good friends, they run Creative Block. They own Creative Block. And so I know, and that's on Mount Baker. But if you wanted something in a CD, that would be a model to explore.
Yeah, that would be really interesting. That would be really interesting. Yeah, I'll start investing in that proposal because yeah, I think it would definitely be good because the like you're saying that there's such a challenge with like space availability in the community. Like, and once you teach people skills, where do they go to like demonstrate their what they've built and how do they create a business around that? How do they invite clients to a space that is patterned for what they've done? So
Yeah.
it's interesting. I'll look into. You say it was Creative Block on Mount Baker?
Yeah. Creative Block on Mount Baker. My friend owns that. Let me see if I can see the website here.
Yeah,
But
if you
that
could drop that in the chat, that would be great.
Yeah, but that's essentially what they do. Their space, different people rent it at different times. Sometimes they hold meetings there, sometimes they hold concerts, sometimes they host a podcast there. But I was just thinking in particular what you could do with a space like that at First Place School, because there's so many different classrooms.
Hmm.
And I remember seeing a video over in Asia actually where, there's so many people creating UGC content,
Hmm.
like, so they're like just all in they rent out different rooms just to film their like content,
Right,
they're filming it for like TikTok videos or whatever, you know what I mean?
right. Yeah,
So
that would be amazing. I was also thinking like one thing I've seen is so the MLK Center in on East Republican Street. I think it's like 29th and East Republican. There's an old school. I can't remember what the original school's name was, but I think it was like First Methodist Church bought it and turned it into a community center. And we hosted summer programs there before the William Gross Center opened.
mhm.
Um, and it has like all the classrooms and things like that. And there
Yeah.
were just a lot of other community organizations running it because there was such a challenge for space. Like everybody's got programming and expertise that they can deploy, but they can't, like the cost of renting space places is prohibitive. So
Mhm.
so being able to have space for those sorts of purposes is really useful. But they at the same time they were struggling to constantly get the place rented out. And so being able to have it be like a place for content creation would be interesting too.
Yeah.
That's good. Let's pursue that lead. And so these were just some general questions about, your relative level of experience in investing. So I imagine, so do you guys do any investment or are you mostly working on your business?
Well, I have some investment in crypto. So I actually advise a blockchain company. So
Oh, nice.
um I started doing that in January 2022 and until now. And so I just like staying in that world because that's where I get all of my alpha, if you will, all my information on like what's going on in the crypto market and when the bull market's coming back and what companies are emerging and things like that.
Hmm. I did a fair amount of research in crypto back in 2017 and got pretty invested. I've divested a bit because just the crypto winter kind of thing. I was like, oh, I better apply my energies to some other things for now. But
Yeah.
it's definitely coming back because the value of the blockchain is just undeniable. Then what brought you to the Black Angel Investing Summit? In this case, I kind of brought you here. Which investment area interests you the most? Do you have any? I mean, if you, well,
I
this, yeah.
Oh, I was just gonna say B stands out for me. So just a little bit of my background. So, I talked about my lengthy career at King County, but while I was there, I was a senior member of the Equity and Social Justice Interdepartmental team for over 7 years. And while, we did some good work and we were proud of inserting an equity lens into government programs, I think, once I was able to step away from the county, I really was able to take a look and see, okay, how do we make ourselves self-reliant? How do we make our community self-reliant? So if government programs don't exist, how do we still have access to build that generational wealth? Because we can't always rely on county government propping up some program saying, hey, we have a grant available for this or that, you know what I mean?
Mm-hmm.
So that B really stands out to me because the past 2 years is what really made me start looking into the idea of establishing trust, people creating family banks, building business credit, just basically doing what the 1% do.
Yep. Yeah.
So
I agree. For the sustainability, I think is so important. And then what is your primary goal for attending the summit? And so I guess since you didn't get the standard invite for this, it might be harder to say. So it's just the two of us. So we'll skip
yeah.
this one
Okay.
and then we'll go right into it. So again, what is angel investing? And so do you have any familiarity with like angel investing off the
I mean, I know about it, but I haven't participated.
Okay,
I know what it is. Yeah.
so this is like kind of like a formal breakdown of like how it participates in the larger like startup ecosystem, and it's useful to kind of go over this just to because there are like kind of careful delineations in each of the funding rounds and so forth in businesses. So on the lower side of this time arrow, we have the different funding round kind of things. They're named slightly differently. So there's friends and family over on the far left. It goes to pre-seed, seed funding, and then startup funding, which is Series A. And then outside of this, there's like Series B, which is okay, you've made it. We need to fund your growth. You're still a little bit risky because anything could happen in the world, but we're gonna fund your growth more directly, and those are like multi-million-dollar investments and things like that. We'll show more data on that. But so on starting from the far left, at the top of the time arrow, we see like the discovery of whatever the problem is, and the founder having some confidence they have some solution for it. Then they have the proof of concept. They've sat there and toiled after in the evenings of their day job to come up with something to solve the product or to solve the market need. Product design, so they're now iterating on the product to make sure that it optimally matches the market fit for what they can spend. And at this point, this is when they're going out to angels or individual angels or groups of angels working in a syndicate to say, hey, here's this idea or this design that I have. I have certain metrics about it that indicate that it might be successful in the market, or I've already gone to market and my customers are, can't get enough of this thing. It's flying off shelves, can you give me money so that I can have more staffing or whatever the thing is going to be to unlock the next stage of the business growth. Then once you kind of get out of that, you're looking at like seed funds or smaller venture capital funds to get you like there. And these really look to fund growth. And so we'll talk more about those. But so once you're out of this kind of like traction metric gaining ground, and when you've proven kind of traction metrics, that's when these venture funds start to look more attractive. But also there's and you're probably aware of this too, there's a point where when the products are flying off shelves and you've really got a growth problem, there's an opportunity to get loans against the collateral of your investment in your business. So at an initial phase, when you're trying to go out, and correct me if I'm wrong here because you're more exposed to the space than me, when you are initially infusing capital in your business, you kind of have to go out and prove your different credit worthiness on the merits of like whatever you cobbled together in life so far, or your credit score, or if you have like a credit based lender or something like that, then you can get that credit. But once you get your EIN, then you can attach credit to that EIN. And I think for you can get multiple EINs, and each one can have a different credit line and so forth.
Yeah.
But as you grow your business, as you get inventory and things like that, you can take loans out against that collateral as well. And so as you scale and grow your businesses, you have more opportunities to get loans. And then as you go forth, you can get larger and larger different institutional equity deposits. And then
Yeah.
eventually there's an idea that you're going to maybe do a public offering and get out of being a private business. And this is one exit method that different investors have to get out. And so angel investing really is just the idea of making the risky bet in an early stage startup, because the more risk that you incur, the higher the returns, well, in this sort of asset class that you can get if the thing actually succeeds.
Hmm.
And there are statistics about that that we'll launch into a little bit later in this talk. And then, yes.
Oh, you'll probably get into it, but do angels require a stake, or do they just get paid back with interest?
They can do it multiple ways. Sometimes they take a stake, but then they'll do like a forced buyback where you buy back the shares on a cycle. Sometimes they do debt issuing, so you'll pay them back. They have deal structures where it's a convertible note, so it's a debt that converts into equity when another investor comes in, and so
Mhm.
your debt then turns into shares, which then get sold up the line to the next investor for a profit. So they've got all these clever deal structures, and so it's not any one thing.
Got
Um,
it. Okay.
there are things that are more conventional and that are designed as standard kind of legal documents to try to reduce the legal fees, because like startups don't have a whole lot of money for lawyers is kind of the idea there. So if you get standard legal documents that the whole legal world knows about and that are kind of like the boilerplate for the startup industry, then the lawyers that specialize in that sort of law just like are like, oh yeah, this is it. I just basically have to look it over, make sure that the terms, that they agree to the terms and know what they are. And so it kind of lowers that legal expense to use certain deal structures versus others. And then, yeah, just reiterating that angel investors invest not just their capital, but their connections and knowledge in early stage companies, which is a time where, that sort of expertise is critical to helping them advance and choose the right directions. And that sort of equity investment of that knowledge capital and that financial capital can generate a higher return if the company succeeds in reaching its product market fit, and hits an exponential on that. And then if you get an exit event, and we'll talk about what those are for this sort of investment, then you can liquidate your shares. Since it's a privately held business, they're not like a public held business where you can just put your shares on an exchange, or like crypto where you can just do that, because crypto is like super liquid in that way. But this is like one of the least liquid type of investments. It's like a certificate of deposit essentially, but with an unknown maturity date, because it can mature like in your face the next day by the business going under. It can mature 3 years down the road when the business gets acquired, or different things like that. So there's a lot of different ways to have an exit event, but outside of an exit event, there's very few ways to recoup your investment. So once you commit, you're kind of in it for the life of the company. It's very much like a relationship. And so, yeah, if you invest before the company can prove its market value, then you get to ride the wave as it finds its market fit. And then investing in small business has a lot of favorable tax treatment. So if you invest in a qualified small business that typically it's most businesses except for businesses in the financial industry, then in the end that company has issued less than $1 million worth of stock. If that company folds, your stock can be your losses on your stock, your capital losses on your stock can be written off against your ordinary income, as opposed to just your capital gains for that year. So if you had other investments, and typically your capital gains can only be deducted against capital losses. or your capital losses can only be deducted against other capital gains. So it doesn't help you with your normal just federal or state income tax. You have to, um, you just basically don't get any benefit from that. But if it's one of these qualified small businesses, then you can deduct it against just your regular federal or state income tax. And not only that, but so the downside is less onerous, but the upside, if you also invest in a small qualified small business and you hold that investment for 5 years, you can deduct up to $10 million in capital gains tax. So it's a huge capital gains exemption if you hit that good case that the investment has gone really well. And so the low downside and high upside makes it a very reasonable activity to do. And so here we have pretty much the anatomy of American business here, where in the beginning, when each year about 500,000 small businesses are created, and it's more like 600,000 around this time. But only 48.7% will survive to age 5. And so here we see the exponential decay of the number of those businesses surviving across the time arrow here at the bottom. But we see that if the small business survives to around year 5, that's traditionally when we start to see equity accumulation in the company. So we see that its revenue grows, that it starts to hire people, and generally the value infused in the business from its operations starts to grow. And so if the company makes it to this point, you're in a more secure position as an investor, and things are starting to go up and to the right. And that's really what investors like to see, is up and to the right. So now we talked about the attrition rate of the small businesses or startup businesses. And here on the right, these are kind of like the boiled down stats that angel investors are particularly interested in. So about 56% of companies fail, about like 35 to 38% fail within the first 3 years. So it's you're waiting that long to find out if the thing has failed, and that's a high rate of failure. And then of course the businesses, some of them will continue to fail as time goes on. There's all kinds of things can happen. COVID can hit and they can maybe weather that poorly, or something like this, right? 35% of investments angel investors make will have marginal returns, or there'll be a small loss, but 9% will return about 10 times what you invest. And so essentially what angel investors are doing is they're trying to make investments such that any one investment can return the whole fund that they've invested. So and that's the sum of all investments across all other investments that they're doing. They look for each investment to be able to, if it does well, be able to replace all of that investment capital if all of the other companies failed. So that's like the success metric that they're looking for. And then now, like, over what period are these investments happening, and what's their relative return perspective to that, or respective to that period. So like I said, within the first 3 years, about 35 of these things are returning 0x, which is you've got a loss. For about in about the 3.5 year mark, they're returning small multiples like 1 to 5x, which is not bad, because if over 3.5 years you've 5 times your investment, you've done well. The S&P 500 returns about 8% over a 10-year cycle. So you're beating the S&P 500 substantially. So there's value being generated here for you as an investor. Here, about 5 years in, you start to hit the 5x to 10x. And so on that previous graph, I'll go back to that. That's when you start to see this guy going on. And so you're seeing a lot of value being generated. Oops. And so that's where you're looking at 5 to 10x multiples. And what'll happen is, if you get an exit event in this, it's typically like the business has reached a new round of investment, or it's been acquired. It's very rare for like an initial public offering or something like that to happen in this time period. And then around the 5 years or later mark, that's when you get into the really high success multiple. So if a business lasts this long and it's met its product market fit, then you're going to see like higher returns across time. So this is kind of the survival threshold. Once they got here, that means they're probably doing something right. And so if you invested way back here at year 0, then you get to see the fruit of all that labor. And so typically the multiple that these investment sees averaged out is about 2.6 times. And the average holding period is 3.5 years. So that's how long you should expect at minimum to see any sort of return on any investment that you make in this sort of asset class. And then the earned annual interest rate equivalent that angel investors and venture capitalists target is about 27%. And so this is basically the returns on compounded returns on an annual basis being 27%. There's a more complicated metric that they use to measure this called internal rate of return, which it's basically like a discounted cash flows across the future, which takes into account just all the different inflows and outflows of capital over the life of the company. But this is kind of that simplified, as you can just think of it as like an APR return.
Is there,
yeah.
I don't know if you'll get into it, but is there like a set of criteria that determines like whether a company is going to be more successful and where angel investors should decide to put their funds?
There is. I go into that a little bit here, but there are more kind of formalized methods, and these are things that I'll get into at the next talk that's happening Wednesday. And so, but basically, there's a standard way called the scorecard method, and you can look this one up. And so, basically, this is the initial part of the of angel investing is essentially de-risking your choices. So you go through and there's different categories like team like nice goodness or competency. There's product market fit. There's size of market. And so with each of these, you assign like a weighted like percentage. So if you think, oh my God, this is the best team in the world, that's like 120%, right? So the most that can contribute to your overall evaluation score would be like 30%. And that, that weighted ratio is across all categories. And so they sum up to some percentage, which is the likelihood that you should invest. And there's maybe about, well, there's probably a lot more, but there's about five or six conventional ones that people use. The scorecard method is the most popular one, but there are other ones that venture for capital firms use that are a lot more math intensive. And we'll talk. I'll talk about this slide, and then what I'll say about how venture capitals do that sort of evaluation will make a lot more sense. So angel investors invest a lot of money since 2012 when I grabbed these stats because they were in a nice, like, convenient package here. Angel investors have taken over as doing the lion's share of investment in the United States. So they invest more overall capital, but they invest more overall capital in more deals. So you see that 67,000 compared to 3,700 deals in the venture capital side. Those ratios have stayed the same to about the present day. They invest a lot more in earlier rounds of the company. So 22,000 compared to 1,760. Just generally, they're investing more and earlier. But the thing that makes them different is their deal size. And so also important stat down at the bottom, we see that they're about 300,000 individual angel investors in 2012. That number has since gone up quite a bit. And venture capitalists, about 522 active firms. And that number's gone up a little bit as well, but it stays pretty low. It's a capital intensive kind of thing. And these venture capital guys, so they are typically a fund of funds. So you'll hear the word general partner and limited partner. So the general partner is the person that evaluates investments, meets all the founders, does all the math to determine whether or not the thing should be invested in. And once they give the blessed stamp of approval for a deal, and they say what the deal terms are, everything and everything are going to be, then their limited partners will come underneath, and the general partner will invest funds on their behalf. So the limited partners are things like CalPERS or like big retirement or pension funds and things like that. So these are, millions and millions and millions of dollars, sometimes billions of dollars. So that's the relative difference between angel investing and venture capital. And so some examples that kind of ate my first bullet point there, but there's Madrona Ventures is a local venture capital firm, and Greenbook Ventures, which is a Black-owned VC firm started by Glenn Gregory, who works in the area. And he's had a lot of the different Black business functions and things like this. So what venture capitals capitalists try to do is really look at all of the future or present market conditions that they can perceive from all their various data sources and apply that to the short-term future of the company and even like the longer-term future of the company. So they have like very complex analytical models that tell you like with high degree of precision what the likelihood is of that company returning an attractive return for them. So they're a more sophisticated investor. They invest in far fewer things. They have to see a lot more people to make an investment because they're only doing like 2 deals a year. Um, and now angel investors, not in the millions range, they're typically investing in the hundred to or from $50,000 to about $200,000. That's about when the cost of doing the deal, the margin associated with the accounting and the legal fees and things like that, where it actually becomes efficient to invest. So you'll see between deals on average between 50,000 and 200,000, or even 250,000 really. So it's at 62% of the deals are in this $100,000 to $200,000 range. And so some examples of that are Keiretsu Forum, which is a global angel investing syndicate. There's the Seattle Angel Conference, which is where I got the bulk of my angel investor education. And then the Washington State Black Angel Network, which is this new angel network that I'm proposing that we build. So
is the Black Angel Network throughout the state of Washington or King County based?
it'll be throughout the state of Washington, but it'll basically start in King County because this is where we have the most connections. But I think that as we grow, there is a significant contention of Black people in Spokane that are doing work. There's significant contention in Pierce County. I know that. I think they're at 14% now. So making sure that everybody has access to an opportunity like this, for lack of really ability to franchise something like this, because it's like and we'll see from this slide as I go into it, it's kind of like a confederacy of investors, where they are a confederation of investors where they're not like tied to the thing. They can invest or not. They're not like obligated to always invest. They just come, they commit to, oh yeah, this time I'll do my evaluation and some collaborative thing, and then they agree to commit some funds. But it's not like a membership due sort of thing where they have to invest, otherwise they get kicked out. I mean, it could be done that way, but it's typically not. It's like really kind of a free form kind of thing. What was I going to say about that? So it would be hard to franchise a model like this and say, okay, you have to give me some percentage of fees, and like the fees don't really scale well along a franchise model. So if you were trying to collect administrative fees or marketing fees for a brand of an angel network or something like that, it would just be difficult. And there's like regulations about like broadcasting that you are raising funds and things like that. So you can't really go out and publicly announce, hey, we've got this angel investing fund and we're going to raise this much money and we're going to do all this kind of stuff. It's like that there are tight restrictions around the language and the sorts of things you can do there. So I adhere to that in these slides, so there's no risk of that coming back to bite on this side. But it would be hard to do that if you're trying to like sell a franchise essentially. So my idea is just try to make this as broad as possible within reason. I felt like on a state base, like it's easier to assemble like regional groups if I create a model that works on a state level, and then we can go to conference and like try to convince other states, black business organizations in other states to like adopt our model. And then, kind of like how NSBE or like what is it, NAACP form, and then you could do your like regional like aggregations and things like that to try to cross promote and do different things like that. So this slide is about who angel investors are and how angel networks kind of typically are composed. So in terms of like structure, typically everyone has equal vote, or sometimes they do pro rata vote. So like depending on how much you invest into the fund compared to other members, that's like the amount to which your vote counts. And so it's like a weighted vote. But commonly it's just an equal vote, and you're investing an equal amount in the syndicate for each business consideration. And then there's also a member managed, which is you've got somebody in your group that is like an investment banker and they know all the deal structure terms and, will pro bono be the lawyer's fees or whatever. So it's like you just let them do the investment, you just chip in the funds. This is more kind of like the VC model, but there's all kinds of hybrids that can exist in between where you actually have like a couple designated fund managers and they get some kind of enhanced education to learn how to do the deal structure and things like that. And then they follow the investment along for the life of the investment and just send you your tax forms and different things like this. So there's all kinds of common mix and matches of these sorts of centralized, decentralized kind of management structures. And then the typical experience of an angel group. And so this is from a Latin American study. About 18% of them have a lot of experience, which is, investment banking or, a serial entrepreneurs where they've had successful exits and then gone on to invest. 54% have very little experience. So, maybe they're domain experts in law, or maybe they're domain experts in a tech company structure, or biotech, or anything that it maybe would be the investment thesis for the angel group. And 28% have no experience. They just are enthusiastic about angel investing and they see the economic potential of it, and they've got money that they'd like to spend in this asset class. So what is angel investing? And essentially this is more like of what is angel investing in terms of how I'm proposing it. So what it entails is investing where we live and in what and who we know. So we know that companies that are founded locally, that maybe have brick and mortar, or who have been through local institutions, they're less likely to up and run off on you. So with your investment, and when you sign on to a relationship with somebody, that person, you want to know to some extent that they're going to be there, right? So this is definitely a relationship, and you want to form it with someone that you know and trust, right? You want to make sure that they know their business, and you can evaluate that a number of different ways. But you also want to kind of know them on an interpersonal level. You want to be sure that they're competent people that have demonstrated, a work history and what they're proposing that they have a market solution for. And then, along our kind of lines, we're looking at investing in Black founders that are working in expanding ventures. And so this is an underserved group. We'll go into, what those numbers are. We want to work as a team to find and prepare Black founders through incubator or accelerator workshops in cohorts that will pass through those. We want to work as a team to find and prepare other angel investors to make sure that they are able to practice good due diligence in investing. And so that you can propagate the knowledge of how to do this sort of cooperative economics, the legal way, which is, this angel investing is a very conventional thing. This is essentially how small businesses funded the United States. And then you can focus on best practice as opposed to gambling. So gambling, like in my terminology, is like just doing like short-term price direction, like what's hot right now. If you heard from a buddy that this sort of thing is going to be popular, so you're just going to throw some money out there and see what happens, right? So instead of doing that, what you can do is screen the deals, make sure that these are legit opportunities that are not just like snake oil or somebody that has something half fleshed out that they'd like you to just put money into experiment with to see if the rest of their idea comes together well. So you want to do your due diligence to go through and see what numbers do they have, what metrics can they show for themselves, what sort of product market fit do they have, how many customers could they sell to if the thing worked and was actually what people wanted. And then, is the structure of the deal right? Are the terms abusive to the founder? Are the terms abusive to the investor? Is it worth getting in a relationship with this person on those terms? And then we will support companies that we invest in. So board seats, advisory boards, executive roles, things like that, giving them contacts, people within our professional networks that, pertain to their business, giving them advice, helping them recruit talent, giving them strategy advice, and then, passing them through incubators, accelerators, and retreats so that they can come into contact with people in a structured way that will help them without interrupting their businesses. And so I say all that to say one of the main issues that we're currently experiencing with angel investing and outside capital access is essentially this kind of color line, which has some very stark numbers associated with it. So outside investment occurs in about 600,000, this is a little bit old, but 500,000, 600,000 startups annually. So about 6% of those companies get investment from venture capital firms. So those big $1 million investments come from these venture capital firms that are doing deals once or twice a year. But 30% are invested in by angel investors. And those deals are typically in, like I was saying, the $50,000 to $200,000 range. The others either seek no outside capital or are doing lending, or they're just kind of bootstrapping from, whatever equity they can pull out of their house or different things like this. But there's an issue that is less than 1% of either VC or angel investment goes to Black founded startups. And so this can in part be attributed to, there's a lot of things, like, so there's learned helplessness, there's lack of availability of knowledge on the subject of capital investment. So people aren't familiar with deal structures, they don't feel comfortable, they're worried, like the social network, oh, am I going to get diluted out? How can I know? I'm not a sophisticated founder. I know how to make, a specific product. I don't know all that stuff. So I'm not going to risk, my life on that. Right. So there's the trust aspect and different things like this. But also, a lot of times these Black founders will go to VC, they'll go to angel investors, and those angel investors or the VC people just can't figure out, well, what are they talking about? Who exactly exists in the world that this product that is supposed to enhance the moisture of hair, or protect it, when like someone's wearing like a wig or something like that, who would want that? That's got to be like 5 people. They don't really understand like the demographic markets that certain products are trying to target, right? And so what could contribute to that lack of understanding? Well, there's some pretty stark numbers in the representation of Black people from the African diaspora in venture capital firms and among angel investors. So only 4% of managing partners at VC firms, that's people that can actually say, yes, this deal will go through, are Black. So that's a very small percentage compared to the overall representation of Black people in the US population, which is roughly about 15%. So we would like to see that number go up, because that's 4% of the people that make those decisions are investing in 6% of the companies in the United States a year. So a small fraction of a small fraction, of money allocating this method. And so angel investors, who we see do the lion's share of the work in the economy in terms of supporting small businesses, only 1% of angel investors are Black. Now, this is a huge gap, huge gap. And in the angel investing space, there are regulations, SEC, Securities Exchange Act of 1933, to comply with, but they're not onerous regulations as there are with VC firms. So this angel investing space is actually very accessible. And so that's why I'm making this proposition. And so we can look at the anatomy of a Black business. This is from, what is it called? EOA study that looks at 2.5 million Black businesses and sees a pretty stark number here. 96% of Black businesses are solopreneurships, non-employer firms. They don't employ anybody. So they might have contractors, but they don't have any employees. And what we see from just non-employment, right? So even if they have contractors, just the fact that they don't have employees specifically, we see that for firms that are founded by women, annual revenues over a 5-year period, 33% of those revenues are about $23,000 a year, which is, you may as well have had a job. It's not even like a great job. It maybe buys you some freedom, for your schedule, for, helping raise your kid and making sure that they, get better economic circumstances by participation in education and things like that. You can focus on that more. But in terms of building generational wealth, your business isn't necessarily doing that for you. It's really kind of deferring that to another generation. The numbers are similar for male founders. They're about double, but still, after 5 years, about 40%, 46%, 50% roughly of those firms are seeing annual revenues about $50,000. And so in a high cost of living area, that's still, nothing in terms of, it's well below the poverty line. But we see that picture reverses rapidly for the 4% of Black businesses that are employee firms or employer firms. So for Black businesses that are founded by men, we see that over 5 years, 69% of these companies' annual revenues exceed $1.6 million. So just by the act of getting employees, we see that the revenue multiples for these companies go exponential. We see that for women-founded firms, that number is a little bit lower at $776,000 annual revenue over 5 years. But now we're looking at significant generational wealth. And so if we're seeing that these type of businesses are not essentially functionally non-existent in the community, and that rather that 96% are of these lower scale businesses that are like almost I mean on an economic basis like inferior to just even employment, then you've got a bit of a situation on your hands. And so this is kind of that situation reflected in graphs. So when the first figure is about racial differences in the source of initial capital for startups. So that's when you first have got your idea and you want to turn it into a venture. Where do you go for the money to do that? To buy whatever you need, to sell, or to add value to, or to market with. So owner's equity, we see that a lot of that is initially invested across all groups. But of course, Black people have lower net worth than other demographics. So, the owner equity infusion is less. Informal equity or formal equity, and these are these sorts of early angel deals and things like that, where they're taking an equity stake in the business. That's essentially non-existent for Black people, whereas those deals exist outside in the tune of $200,000. For owner debt or informal debt, and so these are like credit cards, people are taking out credit things. We say that Black people have less access to credit markets in a lot of cases, just because of credit scoring that takes into account a lot of different things, like your credit score is substantially improved by having a mortgage and things like this. So those sorts of factors start to come into play. And then formal debt, so these are like small business loans and different things like that. So we see that Black people have a lot less access or have a lot less knowledge about accessing those sorts of lendings. So we see that they're, I don't know, what is that, roughly 5 to 8 times less, in terms of capital infusion for starting their business. And the numbers, so the total financial capital investment is significantly less. And this results in, those businesses being less de-risked, because you can't invest in the things that would solve, those risky, parts of your business. And then now if you can't de-risk your business using funds, then you can't absorb economic shocks as well. You can't keep your books in as good enough state. So when COVID hits and they start issuing PPP loans, you might not be able to qualify because you can't afford an accountant, right? You're trying to do your own books and maybe you fell a little bit behind on them. So, so you're at a natural disadvantage in that sort of circumstance. And that comes into play when you go to angel investors too. And they ask these risk-based questions, before they give you money. So you're in a little bit of a chicken and an egg situation, which is, well, how am I supposed to de-risk without money? Oh, well, you should have pulled out of your parents' bank account, should have de-risked that way. And then now you'd be less risky and we'd want to invest in you. But, if you don't have access to that, you won't get necessarily that deal signed. So racial differences in sources of new capital for startups. So this is after the business has been going on for a while. We see that the picture is similar, slightly improved, but similar, to where the total financial capital infusion and the 1 to 3 year mark still significantly less, by half to a third. Oops, let me go back. So over time, the evolution of the total assets in a business, we see that for other demographics, the overall value of the venture is much higher. So $350,000 over 7 years is the average amount that we see in terms of capital infusion into most businesses, right? But Black businesses, we see that it's half that. So that has a lot of knock-on effects in terms of what businesses survive that 3-year mark, right? What businesses survive to that 5-year mark where they really start seeing revenue and employee growth and things like that, right? So if you're at year 7 and you're at the same position that, other companies were at in year 3 or year, 2 or whatnot, or even year 0 for, businesses that don't have Black founders, you're finishing where other people have started. And so you're in this position where you're passing on what, if let's say year 7 is the end of your life, right? You're passing on only about $175,000 to your children. And if you have multiple children there, you've split it up. And maybe that's enough for a down payment on a house in a low cost region. Maybe it's enough just for a car, or to help them get started in business. But it's not much. It's not the $350,000, which is, a significant down payment on an asset or different things like that. So this is the generational wealth gap. And what does
Mhm.
that contribute to? So this is a chart that says if you were born in one of these different socioeconomic class, what's the likelihood that you'll stay in that class versus one of these other classes? So if you're born rich as a Black person to Black parents who have done well for themselves, maybe they've started a business, you have an 18% chance of staying rich. However, you have a 21% chance of becoming poor. So no matter what the previous generation of your family has done, you're still have a higher chance of becoming poor. This doesn't hold for any other ethnic group. It's roughly the same for Native Americans. They're equal chance of staying rich versus becoming poor. Hispanic Americans have a greater chance of staying rich if they're born rich, all the way up to Asian women. So if you're in, I mean, cheers to people on the call. If you're from a family of Asian women, that typically works out pretty well for people. So you have like a 50% chance, a slightly greater than 50% chance of staying rich if your parents are rich. So very, I mean, not born to an Asian woman, obviously that happens for the most births. To be honest, the Asian women is the cornerstone for that. But I think this is saying if they're head of households or if they're the main income producer. So these numbers have to be improved. And so we see if those businesses could see larger capital infusions, if they could see employees, be able to be added to the companies earlier on, you see those giant revenue multiples that end up having better lifetime aggregate in terms of the asset or value of the company over time. So
What are um really quick, not to interrupt your talk,
sure.
but what are some solutions to, you talked about the gap in terms of like, if someone's credit score is affecting them,
Right.
or if they have had to bootstrap and they no longer can, scale their business. So what solutions are in place to get them to a place where they even meet the angel investing criteria? Because if they don't meet that criteria and they still face those obstacles, like what can be done for those businesses?
So unfortunately, the answer is not a whole lot. So it's like they can appeal to friends and family. They can do crowdfunding. They can do GoFundMe. They can do these sorts of low investment means of reaching out. But one of the problems, and I think this is why whenever we show up and we say, "Hey, we're focused on market capital access," people are like, "Oh my God, where have you been all my life?" Right? Because it's like these things just in the environment aren't there.
Mm.
Um, the places where they should be, they don't even exist, right? So the incubator concept or the startup accelerator concept, right? You would hope that after you just taught somebody how to, found a business and how to de-risk their business model and how to make sure that, they've got the right product and that they know who their customers and things like that. Once you've taught somebody that, it would be nice if you could give them money, right, to then go and
Yeah.
execute the thing they have, do some kind of initial investment for them. But just due to the lack of general funds, especially in our region, available like that, I mean, the government should be able to step in, and there's been all kinds of proposals, for the government to step in, but it doesn't for different reasons. And so in limited cases, it does, and then you see like a short burst of things going quite well. But you don't see that capital infusion after you've taught someone how to start a business or like made sure that their existing business is really, going to be able to do something. So this is similar to the situation that you see in like coding boot camps or the situation that ITT Tech got itself back in. It was a big name in like the 90s and early 2000s. But then people were like, "Hey, you promised me a job afterwards. You said that you would train me on these skills, and afterwards you would connect me immediately to economic opportunity, where the thing that we just added value in, I can actually get economic value in. You know what I mean? I'm not just trying to
Yeah.
spend my time becoming a philosopher. I want to actually make money off of the things that I'm investing my time in." And they got sued. I don't know that they still exist, but they definitely don't exist in the same capacity that used to. And you see coding boot camps all over, at least this state, because people are trying to tap into the knowledge economy where the similar thing happens. And so, people are charging people $20,000 to go through a coding boot camp. And at the end of it, it's just, "All right, thank you very much. You have all the skills. I wish you will." And, so this is a big problem. And so I don't think, I mean, this is where I think this is the do for self. I think that this angel investing method exists like in small numbers here in Washington State and much bigger numbers in Silicon Valley and Austin, Texas, and Boston and New York.
Mhm.
Um, and it's a cultural thing too, because here in Washington State, we exist in the shadow of Amazon, we exist in the shadow of Microsoft, and so the way people think I'm going to go make money is by going and working for a publicly traded company, getting equity in that publicly traded company that's already established, already de-risked its business model. There's no risk of you being out of a job tomorrow, and because the startup couldn't make payroll, and then having to find another job and potentially having a healthcare expense. So we just associate, we're like a, what do you call it, a risk averse in terms of how we seek wealth in the Northwest. So, there are outliers to that where people have done quite well in startups and things like that. But people, when they think, how am I going to go get equity in a company? How am I going to go and start my own company? People aren't thinking, oh, I'd better just start up right now and I'll go, find a rich person that, will be inclined to give me money, based off of like limited information, right? There's not that
Yeah.
network isn't really structured here in Washington State, whereas in Silicon Valley, this is like in Silicon Valley started around the semiconductor industry, which was a big part of the space race back in the 1960s and 50s and so forth. So they learned really quickly that this model of syndicate investing does really well towards helping people start up. And so the apocryphal story, I mean, it's not apocryphal. It really is the way things happen. There's a startup investment firm started on a place called Sand Hill Road. And so that was the birth of really angel investing at the time, where people that had made a bunch of money in the semiconductor industry, which was sponsored by government capital infusions, started directly lending and lending on more favorable terms than banks could and things like this. And so they made a bunch of money off of all the different Silicon Valley firms that were gone. So that just turned into the way people made money there. We're just here, we've got that, we're living in the shadow of the big houses and so forth. So essentially, I'm campaigning for a cultural shift towards that kind of model. And there's more information than just that. So the Keiretsu Forum, which is one of the other big angel investing syndicates out there, it's global, actually started as the way that Japan was going to rebuild itself after World War II. So that's the idea of syndicate investing. And to this day, Japan has the lowest amount of outside investment, not because they're not seeking, or not because outside investors don't want to invest, because Japan doesn't accept outside investment for the most part. Like, it likes to invest in itself and be in control of its own destiny that way. It doesn't want to have anybody else dangling any purse strings. And then, in addition to Japan using this model to rebuild itself, South Korea did also after the Korean War. And so they instituted this chaebol system, which was the government initially giving money to some monopolies, and the monopolies, invested in small businesses, and they co-invested in each other. And so it's kind of this elaborate network of co-investment, and so they can like float each other if certain parts of the business of their subsidiaries are not doing well, they float them with other areas of the subsidiaries and do things like that. They reduce prices on goods and stuff like that. So it's like a mix between a vertical integration scheme and this like syndicate investing. So it's a model that's consistently been used to build from nothing. And so that's why I think that, and when you see that only 1% of angel investors, are Black. So it's like, we're not necessarily doing that in our community, and that there are all these, advantages, tax advantages and things like that to doing it, that make it like no impact for people that have that sort of net worth. We just have to propagate the knowledge out there to do it. And I think that this mechanism, if it's adopted, will be the mechanism for doing that sort of capital infusion, because I think it should be. And I'll go into a little bit more about like how those economic impacts like do what they do in terms of creating an economy and creating that safety net. So here we'll kind of launch into the jobs part of it. So startup companies are the driver of job creation in the United States. So the net job creation in startups is this kind of blue graph series here. the net job creation absent startups is this red series here. And so we see the net job creation is negative in just about all cases, except for, it's overwhelmed by the number of startup jobs that are created. So, and it turns out there was a study by an angel investing group from Arizona, the Desert Angels, that found, and Arizona is its own place. It's got its own economic conditions, and employment costs are, I don't know if it's a right to work stake or not, but for every 100,000 angel invested dollars, it resulted in about 5.8 direct jobs being created. And so that had a knock-on effect of about like $500,000 worth of wages, 2.1 million worth of economic output, and about 37,000 in state and local revenue through taxes. So, for a little bit of angel investing, and we see that these angel investing sizes are between $50,000 and $200,000. A little bit of investment goes a long way towards building an employment. And we see that if Black companies, in order to help de-risk themselves, employees would improve that situation. A small capital infusion into a Black company could move them from that low revenue class where it's like not even as good as having a job to the really positive generational wealth, $1 million revenues on an annual basis, kind of category. So this to me is kind of like the bullet, the silver bullet solution for this, which is just get startup money and get angel money into Black companies to get Black companies employees, and then you've seen your 10x multiple. Like the math is kind of straight across. So just to recap, so we talked about angel investing, and it's investing not just your capital but your time, talent, in doing due diligence and detecting solid business models that have potential for growth, and then investing together as a network and expanding that network. And in order to do that, we provide capital that can then have a high return potential. And who are we doing this for? For people that want to make investments in Black-led startups that traditionally have been overlooked, left out of angel investment and VC funding. And so that is the modus operandi of the Washington State Black Angel Network. The reason why we would do this is because Black economics matter, Black lives matter, social justice matters, and economic justice matters, right? So if we see those large disparities, those large market inefficiencies, right, we got to do something about it. When the United States went through the Great Depression, it created the Securities Exchange Act of 1933. It responded and drove wealth to, stabilize the U.S. economy, to make sure that people could buy homes, to make sure that people had jobs and things like that. So it's like, but somehow it has never done anything to address, the economic disparity between the Black community and the white community. So you still have this 10x lower net worth. And so that is the economic justice that we have to go forth. And, since 50 something, Martin Luther King has been talking about this in terms of, how the U.S. government does all this work to create an economic floor for other ethnic groups. But when it comes to Black people, we're always the people that are getting shifted out of the PPP loans. We're always the people that are being drug tested for employment. We're always, getting into all these sorts of, negative situations, only for them to later turn out and legalize weed and make sure that only, white firms can, take advantage of that because they have access to certain capital markets that we don't have access to, right? And so it seems like the system is constantly creating these regulatory schemes to where, white people can be, protected but not bound by the law, whereas Black people are bound but not protected by the law. So how must we act? So I think we should act to support the thriving Black startup investors, startup leaders and investors, by building a robust ecosystem of angel investors focused on Black-led startups. So building, for Black people, by Black people, with Black, interest in mind, to ensure that, you get beyond just the profit-seeking motive, to make sure that you're profit-seeking, but in a space that will have the cumulative effect of creating a virtuous cycle. And then providing Black-led startups with access to capital so that they can reach their market, so that you can get them to that 5-year mark of, being able to grow their business and scale and get employees and so forth. For having found traction in their market, and then continuously building capacity through education and direct experience. And so this is the slide where I talk about what sorts of investments are the kinds of investment that go in. It's kind of mixed with a little bit of other conceptual stuff, but so you can see some of the main markets that venture capitalists and angel investors are going for right now are this artificial intelligence and machine learning, fintech, like, blockchain sort of things, or things related to like credit scoring and lending and different things like that. Software as a service and healthcare. And so these are the different sorts of verticals. Biotech is also an extremely favorable one here. But then, some other parts of this ecosystem that we want to build out in addition to like domain expertise in these, high investment fields is, we want to increase the number of Black angel investors to address like that disparity in making decisions on investment. We want to increase the overall number of POC angel investors because, we see that other communities could benefit from this as well. And so injustice, economic injustice anywhere is a threat to justice everywhere. So we want to make sure that, everybody has access to this sort of model, even if in this particular iteration of it or this particular formation of it, we're concentrating on, changing those numbers that we saw that impact the Black community. The Seattle Angel Conference, including them and other education partners on the Angel Accelerator side to make sure that we're training up as many investors from BIPOC communities as possible. And then also, of course, investing with our impact thesis around Black founders. So who can do it? So an accredited investor, and you're probably already up on this one, it's a 200,000 income requirement for the last 2 years. For single individuals filing singly on their IRS tax returns, or joint income with a spouse not exceeding 300,000 for the 2 years, and a reasonable expectation that they'll do it for the current year. And then either that qualification or a net worth of more than $1 million in assets, not including their primary residence. And this can also, angel investors can also be institutional. So you can see entities with assets in excess of $5 million can invest, and this includes corporations, partnerships, LLCs, trusts, nonprofits, employee benefit plans, family offices of any client of that office. So one exception to this is among the entities that can invest, I think, are financial firms. So if you're a bank or something like that, I don't think you can directly do angel investing through the regulations. Non-accredited investor is therefore someone that does not meet those requirements, but there's ways around that. They're not necessarily angel investing ways, but they're kind of crowdfunding ways. They have certain limitations, but then they reduce this income requirement. So we'll talk about that. So the Jobs Act that was done under the Obama administration allows for investors that make less than $100,000 a year to be able to invest $2,000 or 5% of their annual income, whichever is greater. Or investors that make more than $100,000 per year can invest up to 10% of their annual income. And so this when you issue shares of a privately held company, you have to comply with certain exemptions to the SEC Act. And so the SEC Act is there to protect investors against unscrupulous business owners or people that are essentially selling snake oil. And so that's why they want you to have all this money and all this sophistication in order to be able to do these investments. But the government decided, okay, we can relax that a little bit to allow for things like Kickstarter or Indiegogo or GoFundMe and things like that, where if you have a business that is smaller than that's issuing shares less than value than $1 million, they don't particularly care about the sophistication of the investor. They say, as long as you give them information about the risk of, investing in the asset class of of a startup business, then that's good enough. And so this is good because essentially the Securities Exchange Act of 1933 locked out Black businesses from being able, or Black people from being able to invest in their own businesses in a very real way, or as a syndicate even, right? So it made that, contraband basically. So you start to see after desegregation, this growing gap of, the Black storefronts start to not be able to, upkeep their shops or, pay for the, increasing taxes on their shops or, whatever upkeep and things like that purely by, serving to their community that now, can go to all these different stores and things like that. So it's like, so there's less investment coming from the outside due to the, these stringent laws. In addition to the, split of the market with desegregation. So this Securities Exchange Act, to some extent, contributed to the lack of people being able to build Black Wall Streets and to have thriving businesses. And I think, this is what has led to this, crazy market inefficiency of there being 96% of Black firms being solopreneurships. And so with this, we can create, crowdfunding campaigns that can infuse up to $1 million in these sorts of businesses, or we can form angel investing syndicates with high net worth individuals, in order to do, democratic or, just allocated funds to these small businesses. So I propose, that we do this together as a community, that we prioritize this and that we learn the methods of taking advantage of the different IRS tax exemptions that are available. We work together, we pool our funds, and we invest in Black businesses in a structured way. So what should we do in order to carry that out? We should learn best practices with investor accelerator partners like the Seattle Angel Conference, which will kick off on August 29th. So there are still seats available. If you are an accredited investor, you meet that standard. I could connect you to someone right now, and you could have the experience I did, where one Tuesday evening every week you sit with about 40 other investors and just hear startups pitch at you, and then learn methods for evaluating whether or not those pitches hold water, or whether the information in their data room is good, or whether their cap table looks clean. Learning all those sort of considerations, learning how a deal should be structured in a way that's advantageous to both founder and funder. That opportunity exists. Mhm.
What's the time requirement?
It's from, what is it, 6 o'clock to 8:30 p.m. Every Tuesday from August 29th until November 28th. And then it's also like 3 or 4 Wednesdays in there, because for the first part of it, you listen to 81-minute pitches, which takes just a lot of time no matter how you slice it. And then you have a little bit of discussion in between and whatnot. So it takes up a good amount of time. And so that can spill over into the next day. It's planned out, so it's not necessarily a spillover. It's just those days are allocated because they already see that it'll probably spill over the next day. And then you do your evaluation rounds and so forth, and for each of the successive pitches that were before. And then I think the demo day, which is the big pitch competition of the finalists, which there's usually about 5 finalists, and we select one, possibly 2 they've done in the past from those 5. And that demo day is I think it's a single day, but leading up to it, the due diligence, there's a couple due diligence days that take 2 days. So
Okay,
but
I probably won't be able to commit to this round, but maybe the next one. And
yeah,
maybe
and the next one will
my
start
son too.
in March. And you were saying what now?
I said, and maybe my son too. He might be interested.
Oh yeah, that'd be really cool. But yeah, just let me know, and I can get you connected up to them. They also do happy hour events where they just meet all of the previous SAC, not all of them, but a good amount of them. The previous SAC investors will come together for a happy hour at a brewery or something like that, and you can just chat with them and get to know more about the Seattle startup ecosystem, or their previous investment experiences with SAC and what they liked and didn't like and so forth. And so it's a good opportunity to just kind of network with people that are in the investing space too, in addition to learning more about SAC. And so I'll send you invites for those.
Okay, awesome. Yeah, that'd be great.
And then we have, we'll locate and screen Black startups. So this is called deal flow in the industry. So I want to see everybody. I want to know every Black business in Washington State. That's a very ambitious goal, but I feel we want to do that in order to give them feedback on how they might better structure their business or make their business more amicable to investors, because that means that maybe this business that they have will fail. Maybe they just won't be able to renovate it, in time for it to survive. But the next business they build, they'll build with in mind that they're going to try to seek outside investment or something like that. So then the next time they come and pitch to the Washington State Black Angel Network, they'll be a candidate and be able to actually get investment. And then we'll see them grow their businesses, and if their businesses are successful and they have a exit event, then they can then themselves become investors and things like that. So we're looking to stimulate that virtuous cycle through this. Then we'll partner with Black focused angel and VC investors and develop, as part of our training program, at least 100 Black focused angel investors. And so this round of the Seattle Angel Conference, we were able to put basically 3 Black investors on that panel, whereas before 3 new ones, which brings it to a total of 5 Black investors, whereas before it had only ever been 2 at most at any one given point in time. So we've doubled those numbers. And then I think this current iteration of SAC, they only have 25 investors. So essentially, we've changed the numbers in this specific angel network from having 1% Black representation, or what is it, less than, like, was it 5% or so, and we've changed that to being a quarter of the or a fifth of the total number of angel networks. That so the cumulative vote, you're going to have like a raffle ticket. Essentially, you're going to have like a larger odds of Black people being able to, for their input to count in the cumulative decision.
You know,
So
this,
yeah.
oh, sorry, go ahead.
Oh no, what were you gonna say?
This has my wheels turning because I was actually just I had written in my notebook just the other day how I was thinking about when businesses get funding, right? When they initially start up,
Mm.
sometimes they don't, even if they get the funding, they don't actually know how to proceed and like what support and what resources are in place to like get them started on how to structure their business properly.
Mhm.
Like, and so that's why fundability foundations are really important to me. But I also am part of this other network where there are a lot of women, like fractional CEOs or
Mhm.
fractional COOs or fractional CFOs, or,
Mhm.
you know, just fractional um, executives that could help, like if they're like, once they get funding, they might need like a part-time, you know, a CEO wears so many different hats. They
Right.
might need like a part-time COO to come in there and say, okay, let me structure your operations and
Yeah.
get you up and running. Or let me structure your books and your financial arm, so that, you know, they might need that CFO to just make sure that they have a proper budget and proper, you know, um, structure that they're following in terms of their revenue and their profits.
Yeah,
So
exactly. Exactly. Because I
yeah,
mean, that will significantly improve the ability of that business to grow and develop. And
mhm,
that will significantly improve the ability to generate a return on that investment for for an investor.
yeah,
So, so building this network out, we're very favorable to, creating those executive, placements, doing advising, giving them general strategy advice, but then also embedding people on their boards. So maybe they need a lighter touch, of just help, or they just need a pro they can consult every once again. But generally, they have, the operational capacity or ability to operationalize through people in their network. But maybe, yeah, they're in that position where they're like, hey, I straight up, don't know how to handle my books. Like, I know how to make the hell out of like whatever the widget's going to be, but I don't know how to run a business, essentially, right? And so, they need a co-founder, but then maybe they don't have access to a talent network, or maybe they don't have any trustworthy
right.
individuals in their, corner that they could do that with, that wouldn't,
Yeah,
demand a kidney from them.
yeah, because I guess that's why I asked a question about solutions for resources to get them in a better position for angel investing. Because let's say they say, hey, someone tomorrow says, hey, I want to do this startup. I have this idea for a business, blah, 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 blah.
Mm.
Right. Then they just start doing it, and they're like wearing so many different hats. Then they drop the ball on one thing or another or whatever, and now they're like totally bootstrapping, and now they're kind of going down the drain, I mean down the hole of like trying to patch up all these issues that are arising and trying to overcome all these different barriers. And maybe now they don't have the capacity to build up one area over another, and now they're struggling. And so
Right.
now they're not in position for angel investing because all of these holes now exist in their business structure. So I'm
Yeah.
wondering, at what point, like from the time someone starts up their business to the time the angel network comes in and says, we want to make this deal, like what's that average time in business that business is in operation?
So average, I don't quite know, but I think that really, so if we look to this graph back here, there it is. I think that, so if we're saying that this is where they become attracted to angel investors, right? And so we'll see them all throughout this time period. Like, really, let me see. What we really would want to see is this graph and this chart combined together.
Right. And my thing is maybe so how do we, and I'm not saying you have to do this, but this is just what's going through my head. How do we position them so that in year 5, that makes them attractive to your network? What can we support them with in year 0 to year 5? And this is where I guess this is where I see where I can help fill in a gap, but I can also connect people with those fractional CEOs or whoever they need to get their business structure working correctly from the beginning, so that they don't fail before year 5.
Yeah, and those types of relationships are usually what's called an incubator
Mm-hmm.
or a pre-accelerator. And
Okay.
so, and I think Y Combinator calls itself an accelerator these days, but so
Mm-hmm.
urban impact is one of those in our ecosystem. I haven't actually inspected them myself, but some of the other people that I was working on starting this angel network who have since left, um, they spoke very highly of urban impact. And Mara Wilson, who runs it, who I've known for a while, she runs a lot of local businesses. In terms of getting them prepared, but the only thing is, like, a lot of these organizations are under resourced, so all
Mm-hmm.
they can do is talk about, and not really, like, it's not really a great class. Like, you wouldn't pay a whole lot of money for the class they would give you on bookkeeping or something like this. It'd be just a, cursory, this is what you'll need. I'd love to be able to tell you more, but I haven't actually done it myself, kind of thing. And so I think that, value add for that is to reach out to Urban Impact or William Grove Center. Right now, William Grove Center is mostly doing like youth programs and stuff like that, but it's building up its muscles to be able to do like support services for this and programs like this. And really, this angel investing network and that sort of like work group methodology that I'm putting forth here, like, that's going to mostly live at the William Grove Center. So in terms of meetings and different things, and so, so I think that building those modules into an existing structure is probably a
Mm-hmm.
better way to do it than doing the standing leap of creating your own.
Mm-hmm.
But at the same point, like, I don't know how receptive they would be to that if they're like, no, we're doing fine or whatever. I mean, I'm sure they're probably not like that, but in some cases, you just kind of have to roll your own. And so
Mm-hmm.
that might be something that is worth considering, creating an incubator that is essentially training people for getting access to an angel network or to venture capitalists, right? Through that as like a school. Like, so they have one in Austin, Texas called the Capital Factory, and that has since turned out like the vast majority of startup founders that have received outside investment in Austin, Texas. So it's like there's a lot of value in creating that organ in the ecosystem. And I don't know that it exists in like a cohort model where it's really going to be the long form education that really, gets people in a good place. I
Mm-hmm.
don't know that that exists in our ecosystem just yet. So,
Okay. Yeah, just a thought. Anyway, sorry to
well,
keep
a
in.
good thought. Definitely a good thought. Let's see here. Got through all this. Oh yeah, that was it. So then, so building at least 100 Black focused angel investors is kind of the long form goal of this. So those people can like cycle in and out, for each individual investment decision where, maybe they don't have time this round or whatnot, but it doesn't make or break our ability to do the investment that round, if they're there or not. So, having a large network, and then also these are people that will bring that knowledge out in other communities or start their own angel networks or start their own VC funds. And I've seen that from the Seattle Angel Conference. It's on its 24th iteration this year, and it spun off about 3 different VC firms or angel networks that have done equivalently well or better. So I think the current CEO of E8 Angels is someone that came out of the Seattle Angel Network, and then I think it's I'm not sure if it's called Sea Change Org, but it's run by a woman, Yoko Kano and Minda Bruce, 2 women co-founders. They started a VC fund based off of what they learned from the Seattle Angel Conference too, and then here we are starting the Washington State Black Angel Network. So it's like, the more you get this education out, it's such a high value, education. and the more you get direct hands-on, build confidence in people to be able to execute this sort of thing, the more it'll have what do you call it, like its own legs, like it'll be self-sustaining in that way. And the thing is, it's inherently collaborative. You're not trying to like edge other people out of deals. You're trying to make sure that the company that you're investing in has the most possible investment that it needs to accomplish its objective, to make it attractive to the next round of investor. So if you invest and then another angel group wants to invest too, typically that's a really good thing. And that's why venture capitalists have the structure where they're a fund of funds. So they accumulate a whole bunch of other, funds, and they syndicate the deal and, launch into it together to make sure that they have the big purse, so that the founder doesn't have to be pitching just a pitch. They can pitch to build. And then we will make sure to invest annually in 4 Black companies, at least 800,000, to make a 20% annual interest rate equivalent return on the investment. So that's the investment target. But at least 800,000, even then, I think we want to actually do more than that. This is just kind of initial numbers. Like as we ramp up, I want to get there. But I'd like to see that we do $250,000 deals once a quarter. So $1 million a year, and just really get that going. Because if you can get $1 million a year into, small business in your region, then I mean, you'll see crazy returns on that from small business flourishing. And then they'll be able to come back and contribute investor money, because they'll see how profitable it was for people to invest in them. They'll be a little bit jealous that they don't get to keep all of the returns of their business since they've been diluted by, investors, and then they'll seek to be investors themselves. And so you'll create this kind of virtuous cycle of investment and development. And then this investment opportunity unfolds over about 3 to 10 years. And then there's also kind of a saying that Glenn Gregory gave me, which was a good one, which is, what do you call an investment that doesn't return over a 10-year cycle, and it just stays invested forever and you can't get it out ever? You call it a loss. So sometimes that happens in these businesses too, where none of these 3 things happen that allow you to have a liquidation event, which is they don't raise a second round of funding. They become immediately profitable and they no longer need outside investment. So if you're in a deal structure with them that converts when they do a second round of fundraising, and they never do that second round, well, you will never get your money back from these people. If they never get acquired, that is, they're some people, you ask them, hey, how long are you going to be in this business? They'll say, I'm going to be in this business for life. Or how long are you on this business? I'm going to own it for life. They will never give it up. It's something they want to pass on to their kids. And if they, sell the majority of their shares to outside investment, they don't get to make that choice. So they'll just never do it. So they'll never, let themselves be acquired by another company. Or they'll never go public. And so, going public is the lower rate route. Like a lot of people don't even go public anymore. They do like SPAC deals and things like this in order to reach a public offering sort of thing. So basically, these are the 3 different ways that angel investors will get their money out of the investment that they invest in. And they may never occur, but the common time frame for them to occur is within 3 to 10 years. And then in a previous slide, I show like the likelihood of the returns based off of when one of these events happens. And then we'll be continuously building capacity for regenerative investment. So building the, deal flow side, building the investor side, increasing the amounts that are invested, increasing the quality of education, increasing the ability and availability of mentorship and board seats and that incubator concept. And so what I'd like to do is kind of a lift as you climb model, where you are if you agree to be a part of the network, and you have professional skill, like a pre-qualifier is that you're willing to invest about 3 hours a month in advisement to the startups that are in the network. So that would be a good way to make sure that we're increasing the likelihood of these businesses being able to generate the returns as well.
Yeah, count me in.
Sweet. Oh, that would be amazing. And then, so how is this done, right? What is the economic engine? I'm a little annoyed that it even fits on one slide for all the trouble that it's caused the black population. So essentially the idea, and these numbers will maybe adjust a little bit to be even numbers on the deployment side, but if we look at it at the front end of this, we would charge a 1K admin fee to cover like cost of assembling or convening all of the angel investors and all the marketing that's required to do that, and the coordination of people, just the operational expenses essentially, and legal fees associated with any like a contract service or anything like that. Then we would pool the investment. So we take $2,000 to $5,000 investments from each individual angel investor for the network that period, bringing their total amount of input to the system about between $6,000 or $3,000. So once we've got our $200,000 pooled, there's a flat cost of automation. So this is a legal tool called a special purpose vehicle. So all the pooled investments will roll into that investment vehicle. Why is that necessary? Well, for one, it's so that every year you're required to submit a K1 that goes on your tax return, talking about your the state of your investment, whether or not you've had a capital gain or not, and so forth. So this mechanism automates that dissemination of those K1s. It originates the contracts necessary for you to sign to receive a pro rata share of the investment. And the reason why we go through this hassle in addition to like those efficiency things is because the cap table in terms of who has an ownership share of a company, you don't want that to grow exponentially large, because though that company then has to consult each of those individual investors when it makes like a decision, or if it has like a state of change in the business or certain things like that, right? Depending on the provisions of the deal or the agreement. So if you roll all of those into a single, company that then invests itself into this startup company, then you forego the need to disseminate that information out of the companies need to disseminate that information out, and it gets transferred up to the next person that has done the pooling of the investment. So it's a way to relieve small businesses of that cost, but then also that just doing that makes them more attractive to the next round of investors. Because if the next round of investors look at the company and they see that it's owned, it's got micro fractional ownership of people that, they owe $2,000 to or whatever, they don't want to take on the administrative burden of having to consult or buy out each one of those individual investors and do all this kind of stuff. They prefer to do, single, transactions from the legal side of things, like to reduce their legal expenses too. So what's left after the deduction of that flat automation cost is the deployed capital. So that goes as a pool that now can be invested in a business. So will it be? Yes, it will be. Will it be invested in a given business right off the bat? Not necessarily. So the proposed method of this is what we call an event fund. And this is where you convene the network of Black angel investors, right? And I say Black angel investors, I'm not so specific that the angel investors need to be Black. The founders, the small businesses need to be Black, but the investors, I'll take money from anybody if it makes Black small businesses grow. So we convene that network of people through successive rounds of pitching. So what I did in the Seattle Angel Conference that I think is a good model is you do 1-minute pitches, then you cut it down to a quarter, you do 3-minute pitches, then you cut it back down. Eventually you're left with just about 5 companies, 6 companies or so. And then you do, final round, which they pitch off against each other. And I think these were like 10-minute pitches or so forth.
Did you say 1-minute pitches?
What's that?
Did you say 1-minute pitches?
I did say 1-minute pitches. I was on 2 days worth of calls of 80 businesses doing 1-minute pitches.
Oh my gosh.
It was a lot, but it was good. It gave us what's real. I actually loved it. It was my favorite part because it engages the human element. And one of the best parts of that is when someone comes to investor and they're like, hey, I've got this itch I can't scratch. I've got to bring this thing into reality. That thing can be anything. It can be like, I know how to make the best cheese you've ever tasted in your life. It can be, I make really nice dolls, you see. It can be, I have a toothbrush that brushes, the back teeth better than, it's anything. And it's just like what people are passionate about. This is where it all comes out. And their 1-minute, Hail Mary pitch to some investors. And so I loved it.
Interesting. I was just thinking, like, would I be able to do a 1-minute pitch for Fishbox? I guess that's your elevator pitch, right?
Exactly. Exactly. And a lot of the startup accelerators, they make you create these different length pitches so that if you're in different circumstances, you can deliver the different, scoped pitch. And so
Got it.
I thought that was really clever. And then let's see. And so then we do, the successive rounds of pitching to get it down to one winner. And then a good kind of method of practice that I like that the Seattle Angel Conference did was they made a veto a person. So it's like the fund manager who is like the person that actually will make sure that the deal terms are favorable, and like they get all this kind of extra outside training on this. They'll make sure the deal terms are favorable, and they will, follow up on the investment over the life of the investment, and all this kind of stuff. So that person gets veto power. So if they're like, oh yeah, we all love this company, but if we invest in this deal, we'll get like a 1x return no matter what, right? Because the deal terms are so crappy. Versus if we invest in this other company that we didn't like as much, if it does do well, we'll get a 10x return. So it's like, at the end of the day, they get the final say of whether or not the one that everybody picked is the one that gets the investment. And usually it's an alignment, but you can get like an electoral college kind of situation where it's not. But I still think it's a good practice. And then now once you've done that and once you've made that investment, now you play the waiting game. And you don't have to just wait and twiddle your thumbs. While you're waiting, you can put the startups through scheduled incubators, give them advisory board seats. You can give them board of directors seats that have a little bit more direct say over what occurs inside of the business, or limit what specific sorts of operations they can do. You can also just do like quarterly check-ins to see, well, how's everything going? Is there anything you need from us? Because sometimes, they need more money. And it's like, this is not the ideal case, but it's better to be able to get them another capital infusion or arrange it with someone that is in your network, or that or another VC or something like this, to ensure that the investment survives, or if only they could take a little bit more investment, maybe they found out about a new market opportunity that they could exploit, and they could bring the likelihood of an exit event at a substantial multiple up quite a bit. So, so those sorts of things are things you want to discover in a quarterly checkout, as opposed to after the fact when the thing fails and they're like, oh yeah, we were too nervous to ask for more money after you guys had done so much. So yeah, those sorts of things. And then you have an exit event, which is the thing goes public, and they sell their shares on the NYSE or the NASDAQ or what have you, or they're acquired by a different company, or they are, oh gosh, what was the last one I said? Acquired, I said IPO, and then, gosh, I always miss one of these three. Acquired, IPO, or or the next round of investment happens. So you go from like a seed round to a Series A round, or you go from a pre-seed round to a seed round, or so forth. And then the next investor buys your shares at some multiple. And so from that, you hopefully generate a return. It can be a return from 0.5x, or it can be a return up to infinite amount, right? So from that, in this specific fund, and this is a very traditional kind of model where they do a carry, which is because it takes some amount of work to make this thing happen. There's some marketing associated with it. People generally need to be employed in accountancy and being lawyers, and all kinds of different environmental things can happen. So these funds typically charge a carry. And so this, I think, is important because it attaches an incentive for the fund to actually invest in good things, as opposed to just scaling up the number of investors. Because the only way for the fund to receive money is if we scale up the number of investors on the front end so that they charge the admin fee, as opposed to if the investments actually are profitable and do well. So if you put a carry on the thing, then it incentivizes the overall network institution to ensure that the investments are good, and that you're constantly trying to build something that can produce, well de-risked, good business decisions. And so what would that carry go to? Where that carry would go towards, remember I talked about angel investing, then I talked about a VC fund. The carry would then go towards building a black VC fund. So it would, of course, go into different legal expenses, anything that wasn't covered by the flat admin fee. But then whatever was left from that would go into building a VC fund so that we could generate a larger amount of capital. Or let's say this happens, right? So So let's say the startup that we invested in is great. It's like Calendly or something like that, which is taken off and now is like the standard method that businesses, do things. And so everybody's charging a subscription. Well, now if Calendly goes from its seed round where you have an equity stake of, you've bought 20% of the company as angel investor, then your shares get diluted by the next round of investor, right? Or you sell your shares to the next investor, right? Because you want to cash out at that point, but maybe you don't want to cash out because you see Calendly is just going up, up, up and exponential. So you don't want to get off the bus just yet, right? So what you would do is a follow on. So you would invest more money at the next fundraise round in order to make sure that your shares in the investment weren't diluted by the next round of investment. So by creating a fund, you could also increase your ability, or if a situation like that arose, that you could maintain an equity stake for the fund. And so those are all different sorts of things you can do with this carry. And so, once the carry is deducted off the top, then 80 to 90% of ROI goes to the angel investors who contributed to each investment. And this is according to their pro rata share of investment. So if you invest 2K, you get whatever fractional percentage of the venture that it returns to that. If you invest 5K, you get a greater share. So proportionally. And so that's the mechanism. That's the whole economic engine that drives all this. There's only like a few securities exchange laws that govern this, and some of them don't even apply. Like if you're an investor in Washington State and you're investing in a business that's in Washington State, and when I say in Washington State, I mean you have a residence here, which just means that you like maintain a residence, like a house. You collect mail, at a place. So or rather say you have utilities at a place, really. So if you do that, then you meet the residency requirement, and none of the SEC laws that govern the transactions with shares of small business or of privately owned business apply. Then it only goes to the state laws, the state exchange laws, due to a thing called an intrastate exemption. So, and that intrastate exemption says that it can only be an investment up to $1 million, and you can have 35 unaccredited investors doing that investment. So it's like it's even simpler, and all that requires is just the filing of two forms, and I think there's a $56 admin fee for doing that. So it's like, this isn't hard to do. It's so crazy to me that it doesn't already exist. But for me, I'm like, all right, that's even better for me. The juice is even more worth the squeeze for, doing this. So, so I think this is a good method to solve those market inefficiencies that we saw with employment gap, that we saw with revenue gaps associated with non-employer firms, and, to increase the representation of Black people and angel investors so that, we can decide what we think has value and who can be invested in.
Okay.
And so this is more information about the Seattle Angel Conference. And I'll send you these slides if I haven't already sent them to you. And you can use these contacts. I think the registration for businesses to pitch is already closed. I think that closed on the 22nd. But if you feel like anyone wants to register for the Seattle Angel Conference, you can just reach out to Austin here at his email, and he'll be glad to do it, or to get them signed up ahead of the 29th. Awesome. They won't accept anybody after the 29th. Then they're like in full go mode. So, but now if you're interested in working with us on building this Washington State Black Angel Network, hit this link and register there. It's just a very basic Google form. And this will let me kind of put you on our email list that it talks about, like when we're meeting up and those sorts of things. So that is my proposition. Or if you have a friend that's in a startup who's a Black founder and you'd like them to be able to pitch to the Seattle or Washington State Black Angel Network, then if you could forward this startups.washingtonblackangels.com and have them sign up there, then we'll be able to bring them into our pitching rounds. And so, every time that we do this, and we'll probably do this twice yearly to begin with, every time we do this, they'll be eligible for the next time as well. So if they don't do well, we'll give them our due diligence report and tell them, what we thought they were lacking in. And then, they have the option to improve and then pitch again the next year, and they might win it depending on, how well they institute the improvements.
What's your timeline for building out everything?
So I was aiming for the end of the year. I wanted to do a pitch competition in December on December 29th, which is the Umaja Day, or sorry, Ujama Day of Kwanzaa, which is the day celebrating cooperative economics. But my marketing director at African was like, that's a horrible idea because everybody's going to be doing holiday stuff and nobody wants to bother with that. And so then I was like, okay, well, January then. And so I talked to a guy who was a serial entrepreneur that was like, no, 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 January won't do. And so it's got to be like February, which is fine for me because it will help me, build stuff out. But it's like, that's about when we'll be doing the first investment. So I've got until then roughly to build out the infrastructure for this. So.
And then do you guys, I mean, what's kind of the lead up to that moment? Like, do you plan to have like workshops or like anything leading up to that?
Yeah,
Or
exactly. So these slides that I pitched you, like this is a talk that we did at the Douglas Truth Library on August 10th and had a social event around. We'll keep doing that. And I don't know what the interval is that we'll do that. I'll have to, because I'm doing this through Africatown. They're kind of sponsoring this event series to try to kind of help me build this thing. And so my plan is to just keep doing this to try to make sure that everybody can get their friends in to hear the talk as opposed to just purely looking at the slides. Most people that I even just send the slide deck to, they're like, oh yeah, sold. And they just like sign up or something like this. But like, I'd like to be able to get people seeing each other and like knowing who each other are and engaging that social component. So we'll be doing like mixers, we'll be doing, happy hours, we'll be doing, formal discussions like this. In terms of workshops and things like that, I was kind of relying on this SAC 24 to be like my training mechanism. But I could just as easily, I mean, sit down and train people on different methods of due diligence and things like that. So I might prepare a talk on that or see if I can engage with an outside educational partner to try to get people trained up to that. But I think it might be best to kind of roll my own just to make sure that like people are seeing a consistent, familiar face, doing their trainings and things like that. So.
yeah, I mean, as long as it's not a huge time commitment on you, I mean, I guess I was just wondering, yeah, I was just wondering like, how do people stay connected and, um, leading up to that event in February?
Yeah, it would be basically a series of meetups and just
Mhm.
getting those scheduled across the group and things like that. And I've been pretty intentional with getting them set up after the August 10th thing and trying to coordinate people into getting into SAC 24. And so I'll just be keeping that up and keeping everybody up to date on news and things as they invest and so forth. The unfortunate thing is I had a falling out with my initial partners for doing this. And so I had partnered with the people from the Washington State Commission on African American Affairs and the Enhanced Interactions Group. And it was just like, I just didn't like how they did time management. And this was such a time intensive thing that everything was like falling to
Yeah.
me. And it was just like, well, if I'm going to do this and you're not going to be of any help, I'll do this alone. And
Mhm.
so right now it's just me and luckily I have some people in the Seattle Angel Conference this round, which when they come out they'll be able to like they'll have the same kind of view on things. So I'll have a little bit of help operationally there. So like right now I can put together events pretty effectively, but I would like to have people that can help me operationalize like convening and like communicating with the Angel Network because like Africatown is Africatown and it has to do its events and coordinate the community for a lot of other
Mhm.
purposes, mostly around like housing and different things like that. William Gross Center has a little bit more latitude to serve this mission, but again, they're like have a lot of more youth programs and things like that in focus right now. So it's like
Mhm.
if I could if I could be borrowed some operational capacity from some other people to help kind of build and do the outreach for this, that would be a help as well.
Well, I'll help in any way that I can. I think this is awesome. I think it's a great mission, to accomplish. So props to you for seeing it through.
Well, I really appreciate that. I'll show you one more thing, and then I think we're at time. We're past it, but we're well past. We're well past it. Let me see. So, Silicon
Oh,
Prairie.
what's his name? Oh gosh, why can't I? Um, Booty reached out to me.
Oh, good.
Yeah. So I'm trying to meet up with him. I'm waiting for him to text me back, but yeah, he reached out to me. He's your friend, right?
Yeah, we've worked together on a number of projects. I don't know if he showed you, but we did a youth program where over 9 weeks, we got a bunch of youth using this game engine to build a virtual video of the William Gross Center, which is this beautiful Art Deco fire station where we've built this youth innovation hub. And so,
Uh-huh.
so he worked on that project with me, and now he's got a really great spot on the Seattle Film Commission. So and he does like
Awesome.
a lot of work in AI stuff too to try to do youth programs in AI. So it's definitely a good contact. But one last thing I want to mention, and so this dovetails with like the real life systems talk. So this is Silicon Prairie, and what this is a crowdfunding portal. And so this is kind
Hmm.
of like a startup company that essentially has become a registered FINRA reporting portal. And so it's just a little bit more regulatory compliance, but what allows them to do is essentially broker these crowdfunding deals on their website. And so you have to, in order to do that, you have to do certain regulatory compliance things. But once you do that, you have a portal where you can just say, go here to invest in this company. So a part of investing in these small businesses, if you're not doing an angel investing, which is like the cabal of rich people investing in the one thing, if you use another Securities Exchange Commission exemption for crowdfunding, you can advertise the private sale of these shares of a business. So, for instance, I could say, hey, if you're interested in supporting this Ethiopian restaurant or something like that, here's a link to put in any number of amount greater than $1,000, right? And so you can set these caps and do different things like that. And so it takes a little bit of like legal expense to set this up and to do contracts and stuff like that for this. But the total cost on setting up, your company to get crowdfunded is around $7,000, which is roughly the same as setting up an SPV for the angel investing network. But the angel investors, they can't talk about the investment. Like the Ethiopian restaurant couldn't say, hey, we're trying to raise money in a privately held business. That's strictly forbidden by the SEC. But with this crowdfunding exemption, you can do that. And um so what I'm going to be working on with James is essentially creating one of these that plugs into real life systems, so that, because his real life systems is built around connecting businesses to nonprofits to households to and faith-based organizations. And so, those are all people that want to see small businesses succeed. And so if you can advertise opportunities to invest in your community on your community portal, you're in a good situation. So that's like a thing that is slightly different than angel investing. That is another method for investing in small business. And so I'll be working with him to build this out.
Look at the link I just sent you, Honeycomb Credit. It's very similar. Um, but they actually, there's actually no cost to the business. If you post on there, they will bring out like a film crew and everything and do the commercial and all that stuff and build out your post. But they just take a percentage, I think like a small percentage of whatever your raise is.
That makes sense, because sometimes investors will pay like the legal expenses associated with things like this. And if you have in-house counsel and stuff like that that's dedicated to do it, like those business models become more available. I mean, essentially it'll be just something like this, right? We need something like this that is oriented towards like the Black community. And so
Mhm.
like my initial concepts of it is we'll like, try to externalize some of the operational costs, just because I haven't built any capacity on that just yet. But I have enough context where we could potentially do something like this where it is just a percentage of it or so forth. I mean, and that's a reasonable way to do it, because it incentivizes you to make sure that the investment, is made, because you're getting a percentage of it, all this kind of stuff. I mean, I generally agree with those sort of incentive models. So, I mean, yeah. And then the other thing is, for the crowdfunding thing, it doesn't have to just be like equity stakes and things. You can also sell debt stakes and things like that. So,
Mm. Yeah, they do debt, and I guess what's nice, because this is something that we were considering for Fishbox, but they do debt, but they also facilitate the distribution of payouts to all of the investors.
yeah,
So
that's part of it as well. Yeah.
yeah.
I think that's called a transfer exchange. There's another word for that sort of businesses, that sort of business. This Silicon Prairie company is one. It's called a transfer agent. That's what it's called. So yeah, that's sort of functionality where you're keeping track of like the fractional ownership where you're giving all the investors their K-1s for their IRS returns, and where you're doing the disbursement of funds. And so this is debt. So they've got the interest rate, which returns on a cycle. So they, are doing those disbursements over a time period. And so, you'd have to have the organ for doing that too. So that, I think that's a reasonable way of doing things.
Yeah, it's just an example that I thought you could look at. Might be
Yeah, I like
useful.
it. I mean, I would like as many examples as possible because ultimately I want to look at what's already been done, where the strengths and weaknesses are, and make sure that we build the best thing for our community. So this is good. But I mean, I
The
just love
UI,
things.
the UI is really like, looks really eye-catching,
Yeah, and you know what's
so
crazy to me? So I'm like a software developer guy that works on building these sorts of sites. And so little things stand out to me. So like the fact that this
yeah.
heart is like in the corner there,
Oh,
and I don't even know if it's functional, you know what I mean? It's like those sorts of things imply to me, these people are working on a shoestring budget, like the people that are putting together these crowd portals. And it's like
yeah,
we could very easily do this. Like this is not more complicated than most of the Wix sites you'll see. You know what I mean? So it's like there's not much to this. Like I think the bulk of the work in a business like this is on the regulatory compliance side, but like this
yeah,
UI is like super simple, and like there's all these like template builders now that make it like it's a little bit better because it like a lot of those template builders have these like horrible menuing systems and stuff like that, but this and these like little progress bars and things like that, like creating this
yeah,
tile with the complexity. But anyway, yeah. So, but it's not hard, is the thing.
yeah. I think that, who was the guy that was doing the filming? Was his name Daryl?
Yeah, Daryl, he's my
Or
cousin,
like,
by the way.
oh, really? Oh,
Yeah.
that's good to know. Yeah, but like, just imagine, like, that's what I liked about Honeycomb was they make it really easy for a business, like, to just say, okay, if we want to do something like this, they're like, we'll bring a camera crew, we'll bring like all these things to get your content done, and it just shows consistency throughout the platform.
Yeah. Yeah. Plus, it's like, because like once you do something like this, it's almost equivalent, it's an equivalent, what would I say here? Effort in terms of setting up this deal structure so that, oops, where was it? Where was it? Well, all right, we'll just do this one. So it's like an equivalent effort to set up one of these deals as it is to market it. Because it's like once this
Hmm.
exists, but the cool thing about this is like so much of this crowdfunding thing and even angel investing is converting your social capital into market capital. And so,
Yeah,
if you have a broad network, like in the Black community, we have a giant network, right? We all like know each other essentially, or we're like one or two people away, you know what I mean, through a relationship or two, through dating or marriage or something like this, right? So it's like, especially in the Northwest. So it's like if you can convert that to people donating like $1,000, right? Especially with all the community impact organizations like we have, like Africa Town, like the Washington State Commission on African Affairs, like gosh, what are some other ones? Converge Media with Trayana Holiday and all those folks, right? It's like, or Daryl in Real Life Systems, and Daryl does a whole lot of other things too. It's like I think he's like Dancing in the Rain Studios, but if we've got a lot of mouthpieces to advertise about Black business, and we're not in this position where nobody cares if there's another Black business. Everybody's like, yes, oh my God, good to see us, right? It would be great if there's another Black business. So it's not like, so people care and people want to support that, and if you can do it for a low stakes way and you can market it effectively, like you'll have great results. I mean, I feel like the angel investing side of thing, it relies on finding high net worth individuals, and it relies on being able to convene them. It's a lot more time intensive. I mean, but with that said, I think that we'll be able to like invest more money, and I think it's good just for people to understand what they're investing in the community so they can do more complex deals. So I definitely want to do both things, but I think that we have to get a crowd portal together so that we can tap into people that don't have that high net worth or things like that, or that income,
yeah.
but
Mm.
just still want to support the businesses.
Yeah, definitely. All right.
Yeah, well, thank you very much for,
Yeah.
for reading.
Oh, Ibrahim couldn't make it because he was doing a catering event today.
Uh,
So, did you still want him to come out and look at the kitchen tomorrow morning
yeah,
or?
that would be great. That would be
Okay.
great. Did he say he was available at 10?
I'm pretty sure he will be.
Okay.
Where should he meet you? Which building is it?
The new building. So it's at 1601 East Yesler Way.
1601 East. Okay, I'll let him know, and I'll give him your contact information if he can't make it at that time, but I think it should work.
Okay, that'd be great. And you have my phone number and everything because we texted. Okay, perfect. So
Yep. Yeah. So, okay, thanks, Evan.
Hey, thank you. It's good to see you, Janice.
Good to connect. Bye.